Hello everyone, this is Dr. Vara Lakshmi and I'm going to be discussing you the entire problems that covers in this business economics and financial analysis. First, we'll have a discussion about the break-even point related problems and the solutions. So break-even point, the point at which where the organization will get no profit and the no loss is called as the break-even point. Let us see, from the following particulars, find out the break-even point. What should be the selling price per unit if the break-even point should be brought down to 6,000 units, and the additional information which they have provided for us is variable cost per unit is 15 rupees and the fixed expenses are all 54,000 and selling price per unit is 20. So now, as per the given information, if we have calculated this contribution per unit, the formula for the contribution per unit is equals to selling price minus variable cost per unit. The given problem, 20 rupees is the selling price and 15 rupees is the variable cost, so that each product is going to be contributing 5 rupees. And they have provided fixed expenses of 54,000 means they have to sell 10,800 number of units to get no loss, no profit point. Then there also has provided for us and another information is that what should be the selling price per unit if the break-even point should be brought down to 6,000 units, which means break-even point already we have they have provided that assumption is 6,000 number of units and the fixed expenses are 54,000, and so that the contribution per unit will become the 54,000 divided by 6,000, that means 9 rupees. If the contribution is 9 rupees means, as we know that one contribution is equals to selling price minus variable cost. The variable cost they have provided 15 rupees. Now, if the selling price is 24 rupees, then only they can bring this particular 6,000 units or only as a target for the break-even analysis. And the second problem is the fixed cost amount to 50,000 and the percentage of variable cost to sales is given to be 66 2 by 3%. If 100% capacity sales are all 3 lakhs, find out the break-even point and the percentage sales when it occurred, determine profit at 80% capacity. The percentage of the variable cost to sales is 66 2 by 3% means that is 66 into 3 plus 2, that is 200 divided by 3. Then we can calculate, as we know that one percentage of contributions to sales is 100 minus percentage of variable cost, that is percentage of contribution to sales is 100 divided by 3. Now from this one we will calculate this P/V ratio, that is contribution divided by sales into 100, and the contribution is 100 parts of the 3 and the sales is we have assumed 100 and into 100 means 33 1 by 3%. And break-even sales is equals to, we have a formula called fixed cost divided by the profit volume ratio, 33 1 by 3%. So out of this one, 50,000 into 300 divided by 100 means 1,50,000. And hence BEP occurs at 1,50,000 out of the 3 lakhs into 100 is equals to, at a 50% capacity, the BEP is going to be existing. And they have given another information that if the profit is at 80% capacity, at 100% capacity of the sales 3 lakhs, if it is reduced to 80% capacity means it is only 2,40,000. Now the total contribution at 80% capacity will be reduces to be 22,40,000 into 100 divided by 3 into 1 by 100, that is 1/3 of this 2,40,000 is 80,000. If we less the fixed expenses of 50,000, profit at 80% capacity is 30,000. Now, the next problem is from the following information, ascertain by how much the value of the sales must be increased by the company to the break even of sales is 3 lakhs, variable cost is fixed cost is 1,50,000 and the variable cost is 2 lakhs. And for this one, break-even point is equals to fixed cost into sales divided by sales minus variable cost. That is 1,50,000 into 3 lakhs divided by 3 lakhs minus 2 lakhs. That is 4,50,000 is the total break-even point. And if the sales is to be increased by the company to the break-even are 1,50,000 worth of the amount are increased when compared to this break-even sales. And from the following data, you are required to calculate amount of the fixed expenses, the number of units to break even, the number of units to earn a profit of 40,000, and the selling price per unit can be assumed at 100 rupees. And the company sold in 2 successive periods of 7,000 units and 9,000 units and has incurred a loss of 10,000 and earned a rupees of 10,000 as profit respectively. For this one, they have provided the 2 sales informations. That is when they have incurred 7,000 number of units if they have sold. Each unit is at 100 rupees means 7 lakhs as well as 9,000 into 100, 9 lakhs. So there are 2 cases. The profit and loss. The loss is at 7 lakhs is 10,000. The profit at 9 lakhs is 10,000. Thus, for an additional sale of 2 lakhs, they are going to be contributing 20,000 rupees. This last 10,000 plus 10,000 additional profit, which has wiped off the losses of 10,000 of period 1 and earned a profit of 10,000 in period 2. From this one, we can calculate the P by V ratio where it can be calculated with a formula of change in contribution divided by change in sales. Change in the contribution is 20,000 and the change in the sales is 2 lakhs. So that the PYV ratio is 10%. And so contribution of period 1 is 7 lakhs into 10% means 70,000 and last period has given 10,000 means total 80,000 of the contribution at that time period, and the fixed cost is equals to contribution is equals to fixed cost plus or minus profit and loss. We know that one. So that the fixed cost is equals to contribution plus or minus loss or profit. And also we can calculate with the formula of fixed cost with this break-even point in the form of fixed cost divided by P by V ratio means 80,000 divided by 10% means 8 lakhs worth of a break-even point, and the number of units to the break-even point is 8 lakhs divided by 100 rupees they are selling means 8,000 number of units, and the number of units required to earn a profit of 40,000 means fixed cost plus desired profit divided by profit earning ratio. Fixed cost is 80,000 and the desired profit is 40,000. 1,20,000 into P by V ratio is 10% means 12 lakhs worth of the amount they have contributed under the they have to be earn a profit of 40,000. And the problem number 5. A company is making a loss of 40,000 and relevant information is as follows. Sales worth of 1,20,000, variable cost worth of 60,000 and the fixed cost of 1 lakh. Loss can be made good either by increasing the sale price or by increasing the sales volume. What are break-even sales? If present sales level is maintained and the selling price is increased. And the B case is if present selling price is maintained and the sales volume is increased. What would be sales if a profit of 1 lakh is required? First A case we have required break-even sales is equals to variable cost plus fixed cost, that is 60,000 plus 1 lakh, 1,60,000, and the sales are 1,60,000 we have calculated. B case Sales are 1,20,000. Variable cost is 60,000. Have provided contribution is equals to the sales minus variable cost 60,000. Profit volume ratio is equals to 50%. We have calculated by using the formula contribution divided by sales into 100. Now the break-even sales can be calculated with the formula of fixed cost divided by the PYV ratio. That is 1 lakh divided by the 50% means 2 lakh rupees. And now the third case, they have told that desired sales is earned to a 1 lakh means fixed cost plus desired profit divided by the profit earning ratio. Already fixed cost is 2 lakhs and the desired profits are 1 lakh. 50% is the profit earning ratio, so that it will become the 4 lakhs. So that is about the break even point calculation. And if we have come to know the simple problems related to this break even only, Pepsi company produces a single article. Following cost data is given about its products. Selling price is 40, marginal cost per unit is 24, fixed cost per annum is 16,000. We need to be calculate the P by V ratio, break even sales earning a profit of 2,000, profit at the sales of 60,000, new break even sales if the price is reduced by 10%. So we know that these are all the formulas, that is selling price minus variable cost divided by the sales is equals to fixed cost plus profit, or selling price into profit volume ratio is equals to contribution. So P by V ratio is equals to contribution divided by sales into 100. So that P by V ratio we can calculate as selling price minus variable cost 40 minus 24 divided by 40 into 100, that is 40% P by V ratio we have calculated. So second problem, break even sales, they are asked you the fixed cost selling price into profit volume ratio is equals to fixed cost. So that sales into variable P by V ratio 40% is equals to fixed cost, so that we can calculate as the break even point as 1,000 units or 40,000 amount. The sales to earn a profit of 2,000 means, so for the same formula we have added profits to this fixed cost. It has increased from 125 units, that is 100 and 125 units, and profit at a sales of 60,000 means here they have given this sales value, profit we have to calculate. So 60,000 into 40% P by V ratio is equals to 16,000, so that the profit is 8,000. And they have given you another one also, the new break even sales if the sales is reduced by 10% means actually the selling price is 40, and if it is reduced to by 10% means 4 rupees is the 10% of 40, then it is become 36 rupees, and the marginal cost is 24, contribution is 12, then P by V ratio is equals to contribution divided by sales, that is 33.33%. Now the sales into P by V ratio is equals to fixed at a break even point is equals to fixed cost, so that the sales will be of 48,000. That's about another kind of the break even point. And if we have seen this, the next problem, from the following information find out P by V ratio, sales and the margin of safety. The information provided to us is fixed cost, profit and the break even point. P by V ratio is a formula can be calculated with the help of sales minus variable cost is equals to fixed cost plus profit, or sales into sales minus variable cost divided by sales, that is equals to fixed cost plus profit. So that break even sales can be calculated by using the P by V ratio is equals to fixed cost divided by the profits, then it is become 50%. Sales for this one, as we know that formula is sales into P by V ratio is equal to fixed cost plus profit, whereas the contribution sales is equals to contribution divided by the P by V ratio, so that 40,000 of the contributions plus 20,000 is the profit they are expecting. P by V ratio is 50%, and the sales are all 1,20,000. Margin of safety, the total sales minus BEP sales will be gives us the margin of safety. And the next problem is from the following particulars calculate break-even point in terms of sales value and in units. Number of units that must be sold to earn a profit of 90,000. Fixed factory overheads cost is 60,000. Fixed selling overheads cost is 12,000. and variable manufacturing cost per unit is 12, variable selling cost per unit is 3, selling price per unit is 24. The total variable cost is 15 rupees. And fixed factory, this is a fixed cost, 72,000 is the fixed cost. And this is the information provided for us so that we can calculate it. The break-even point is equals to fixed cost divided by selling price per unit minus variable cost per unit. Variable cost is 15 rupees and total fixed cost is 72,000, and the break-even can be calculated as 8,000 units. And whereas the number of units that must be sold to earn a profit of 90,000 means already for the fixed cost they have to add this expected profits of 90,000, so that it will be 18,000 units. The next thing is, from the following data, you are required to calculate P by V ratio, break-even sales with the help of P by V ratio, sales required to earn a profit of 4,50,000, fixed expenses of 90,000, variable cost per unit is direct material 5 rupees, direct labor 2 rupees, direct overheads 100% of the direct labor, and the selling price per unit is 12 rupees. From this one, selling price per unit is 12 rupees they have provided. If we add the direct labor, direct material and overheads cost of total 9 rupees, then the contribution per unit is 3 rupees. So we know that P/V ratio is equals to contribution divided by sales means 25% of the P/V ratio. Break-even sales means fixed expenses divided by P/V ratio means it is 3,60,000. And the sales required to earn a profit of 4,50,000 means for the same thing we have to add this expected profits of 4,50,000 so that it can calculate it as 21,60,000. The next problem is, from the following data, you are required to calculate break-even point and a net sales value at this point. If the sales are 10% and 25% above the break-even value, determine the net profits. Direct material cost per unit is 10 rupees and direct labor cost per unit is 5 rupees and the fixed overheads is 50,000 and the variable overheads at the rate of 60% on the direct labor is 25 rupees of selling price, trade discounts of 4% they are provided. From this one, we can interpret that selling price per unit is 25 rupees. If we allow this trade discount of 4% on 25 rupees means 1 rupee. So the net selling price per unit is 24 rupees. From this one, if we less the variable cost of 10 rupees, 5 rupees, 3 rupees, total 18 rupees from this one, the contribution from that particular material or from that particular product is 6 rupees. So that the break-even point for to meet the fixed expenses of 50,000 is 8,333 number of units. And for this one, from this one, we can calculate the P/V ratio of as 25% by using this formula of contribution divided by sales into 100, and hence BEP in number of the sales can be calculated as 2 lakh rupees. That is 25% of 50,000. But they have provided as profit when sales are 10% and above the break-even volume will be means sales is equals to this fixed cost, the break-even is 2 lakhs and 10% of 2 lakhs means 2,20,000 it should be, and the contribution will be of sales into P/V ratio means 2,20,000 into 25% means 55,000, and the contribution is equals to fixed cost plus profit means the profit will be of 5,000. When the sales is 25% above the break-even volume means if it is 10% is done, same thing we can apply for the 25%, then it will be 12,500. So that is about the break-even point. The next problems is about the payback period. The Delta company is planning to purchase a machine known as Machine X. Machine X would be cost 25,000 and would have a useful life of 10 years with zero salvage value. The expected annual cash inflow of the machine is $10,000. You are required to calculate the payback period of Machine X and calculate whether or not the machine would be purchased if the maximum desired payback period of Delta company is 3 years. So they have provided the total cost of that particular product is they are going to be investing 25,000, and the life of that one is they are going to be 10 years, and they are going to be expect every year as 10,000 as a returns, means the payback period will be of 2.5 years. The expected life of that particular asset is 10 years, so it is better to purchase that particular machinery based on the payback period. Very simple problems of this payback period. So due to the increased demand, the management of Rani Beverage Company is considering to purchase a new equipment to increase the production and the revenues. The useful life of the equipment is 10 years, and the company's maximum desired payback period is 4 years, and the inflow and outflow of cash associated with the new equipment is given below. Initial cost of the equipment is 37,500. Annual cash inflows are all sales 75,000, cost of the ingredients 45,000, salaries expenses 13,500, maintenance expenses 1,05,000, non-cash expenses like depreciation 5,000. If we have seen the in and all total, they are all spending 45,000 plus 13,500 means 58,500. 58,000 plus 59 plus 60. 60,000 they are all spending out of their sales, means their revenue or the contributions towards this expenditure is 15,000. Every year they are going to be get 15,000, and they have spent 37,500 means 37,500 divided by 15,000. So that will be the payback period of the organizations. That is 2.5 years is the payback period of the organization. Next thing is the management of Health Supplements Incorporation wants to reduce its labor cost by installing a new machine. Two types of machines are available in the market, Machine X and Machine Y. Machine X would be 18,000 rupees cost, whereas the Machine Y would be 15,000. Both the machines can reduce annual labor cost by 3,000. You are required to calculate which machinery has to purchase based on the payback period. Very easy that Machine X is costing 18,000, Machine Y is costing 15,000. Both are going to be giving the same benefit, means Machine X cost will be returned by 6 years, whereas the Y is returned by 5 years. Obviously, Machine Y is better to purchase than the Machine X. The next concept is about the accounting rate of return. The accounting rate of return is going to be calculating with the formula of average annual profit divided by the average investment. From this one, investments, we can calculate this average rate of return. Let us see this problem. XYZ company is looking to invest in some new machineries to replace its current malfunctioning one. The new machine, which costs $4,20,000, would increase annual revenue by $2,00,000 and annual expenses by 50,000. The machine is estimating to have a useful life of 12 years and zero salvage value. From this one, we can calculate the average annual profits of the cash inflows for the year one. It is year one, every month they are going to be get 2 lakhs, means 2,20,000 of the rupees, so they are going to be get which their revenue by 2 lakhs rupees and annual expenses by 50,000, means for the 12 years they are going to be get, that is 24 lakhs rupees of the amount they are going to be get for the 12 years. And if we less all the annual expenses of 50,000 for the 12 years, we can less the 6 lakhs out of that one. And we can less the depreciation of 4 lakhs 20,000. So that the total profit is at 13 lakhs 80,000. And average annual profits will be for the 12 years. If we calculate per year, they are going to be get 1,15,000 as average annual profit, and average investments is they are going to be investing 4,20,000 and zero salvage value, means on an average they are going to be spend 2,10,000. So which means on an average they are going to be get 54.76% of average returns on their investments. Now the problem 2, if we have seen, XYZ company is considering investing in a project that requires an initial investments of 1 lakh for some machinery, which will be net inflow of 20,000 for the first 2 years, 15,000 in a next 3 and 4th years, and 30,000 in this year 5. Finally, the machine has a salvage value of 25,000. Here, once if we have seen, the first 2 years they are going to be get 40,000, second, third and fourth years they are going to be get 30,000, and the fifth year they are going to be get 30,000. So that the depreciation, if we have less, the total net profits of that organization is $3,000. So, and average investments is also again 37,500 divided by the number of 5 years. If you have taken, it will be the 3,000 divided by 37,500 means 8%. And an average, they are going to be get a net profit of 8% for their investments. And the third problem, let us take the example of real estate investments that is likely to generate returns of $25,000 in first year, 30,000 in the year 2 and $35,000 in the year 3. The initial investment is $350,000 with a salvage value of $50,000 and estimated the life of 3 years. Do the calculation, the average rate of return of the investments based on the given information. Annual net earnings are all year 1 25,000, year 2 30,000, year 3 35,000, and the estimated life is 3 million and total investments is 3,50,000 and the salvage value is 50,000. From this one, we can say that average annual returns are all total 25, 30 and 35 is equals to $90,000 divided by the life of the year, life of the project is 3 years, means on an average they are going to be get an annual return of 30,000 and average returns is equals to 30,000 divided by 3,50,000 is an investments, out of which the salvage value is 50,000, means they are going to be get a average rate of return value of 10% for the investments. And the next problem is about the fourth problem. An initial investments of 1,30,000 is expected to generate annual cash inflow of 32,000 for the 6 years, and the depreciation is allowed on the straight line basis. It is estimated that the project will be generate scrap value of 10,500 at the end of the 6th year. Calculate its accounting rate of return, assuming that there are no other expenses on the project. Annual depreciation for the product can be calculated with the help of the formula initial investments divided by the scrap value divided by the useful life of the project. And so that initial investment 1,30,000 minus scrap value of 10,500 and the life of the project is 6, means the depreciation is 19,917 and an income is 32,000 of amount. Out of this one, the depreciation if we less 12,083 rupees is an average annual income, and accounting rate of return is average income divided by the net investments, that is 1,30,000 they have invested. So on an average they are going to be get a 9.3% of the returns. And the next problem is a company is considering to purchase a machine A and B and are available for 80,000 each. Earnings after taxation, the information they have provided. First, we need to calculate this payback period, means here only we can do this cumulative elements. 80,000 they have invested for each machinery, means year 24 plus 32, 68,000 they have received, and 68 to 40,000 means it is 1,08,000. So here 80,000 is between this 2 and 3 years. 2 years are already completed, 2 plus, and 68,000 cumulatively they have received. Remaining 12,000 only they have to receive by the 3rd year, out of which 32,000 rupees of the amount they have to get. 3 by 8, generally 3.22 something they'll get. That means 2 years, 3 months, 6 days will be the payback period for the machine A. And here it is 24,000 plus 8,000 means 32,000 they are going to be get. And here it is 64,000 and here it is more than this one means obviously it is increased by 3 years means as per the payback period machine A is better than the machine B. Once if we have seen same as machine A is better than machine B, but if it is based on the average annual cash flows, average annual cash flows for the machine A is for the 5 years means 27,000, for the machine B it is 28,800, and the depreciation for both the machineries is the same because the same cost and the same number of years they are using means 16,000, and annual net savings from this machine A is 11,200, from the machine B is 12,800. As per the payback period machine A was the good, but as per the average rate of returns if we have seen machine B's average rate of return is more than the machine A's average rate of returns. And also, if we have followed this net present value methodologies, again, this will be definitions or the information will be changes because in the NPV method, they are taking the time value into the consideration. Here, the NPV will always thinks about the present value of the cash inflows should be more than the present value of cash outflows. So for this one, we'll see one more example of this present value of that one. The management of fine electronics company is considering to purchase an equipment to be attached with the main manufacturing machine, and the equipment cost will be of 6,000 and will be increases annual cash inflow by $2,200. The useful life of that equipment is 6 years. After 6 years, it will have a no salvage value, and the management wants to 20% returns on all the investments. We are required to calculate the NPV method. Initial investments of the project is 6,000 and the life of the project is 6 years. Annual cash inflow is $2,200. Salvage value is 0 and their expected rate of return is 20%. So that first we need to calculate the present value factor for 3 years. For the 6 years at the rate of 20%. So if we have seen this A4 table, its value will be 3.326 and every year they are going to be get 2,200 means for the 6 years cumulatively the time value of the money will become 7,317 rupees, whereas they have invested 6,000 rupees as their investments, so that amount will be 1,317 rupees. It is giving the positive value. So as per the NPV decision rule, we can accept the project. And smart manufacturing company is planning to reduce its labor costs by automating a cricket task that is currently performed manually. The automation requires the installation of new machines. The cost to purchase and install a new machinery is 15,000. So the initial investment is $15,000 and the installation of machine can reduce annual labor cost by $4,200 and the life of the machine is 15 years. The salvage value of the machinery after 15 years will be 0 and the required rate of return of smart manufacturing company is 25%. So we have to calculate the NPV for that organization and they have invested 15,000 and the life of the project is 15 years annual cost savings is, that is cash inflow is $4,200 and their expected rate is 25%. At the rate of 25% rate of return for 15 years, the annuity value for the 1 rupee is 3.859. Then if we apply for the 4,200 rupees, then its value is 16,208, and they are now investing 15,000, means as per the present value of the money, they are going to get a profit of 1,208 rupees. As per this one, it is better to provide them to purchase that particular machinery for the association. And the next one is, a project requires an initial investment of $2,25,000 and is expected to generate the following net cash inflow of year 1, 95,000, year 2, 80,000, year 3, 60,000, year 4, 55,000. And as per the desired rate of return 12% we need to calculate. Previous problems, the net cash inflows were equal for all the years. But here, the net cash inflows are all not equal, they are uneven. That's why, first we'll calculate the 1 rupee present value at the rate of 12% by using the formula 1 divided by 1 plus r to the power of n, whereas r is 12%, that is 1 plus 0.12, and n is the number of years. If it is a first year, divide whole to the power of 1. If it is a second year, whole square. Third year, whole cube. Like this, the n values we can take as the number of years, and this is the 1 rupee values and present values for the 12% rate of return at different years. And they have provided the cash inflows are also 95,000, 80,000, 60,000 and the 55,000. If we multiply these present value factors with this cash inflows, then we will get the present value of the cash inflows. Its cumulative value is 2,26,295, and that can be minus with this initial investments. There is a positive returns of 1,295. Then it is better to purchase this particular, it is better to invest into this particular project. That is the analysis of the NPV, and the choose the most desirable investment proposal from the following alternatives using the profitability index, means they have provided the XYZ company's cash inflows, investments required, and the present values they have provided, net present values they have provided. And the profitability index means cash inflows divided by cash outflows, that is 2,12,000 divided by 2 lakhs, 1.06. From all these ones, project Y is having the more rate of return than the project X or the project Z. So the project Y is accepted. So that is about the calculation of the every projects based on the NPV as well as the profitability index and ARR and payback period. The next most thing is creating IRR for any project, means here in this NPV we have calculated for the given rate of return, we have calculated the present values, but any given rate, that rate of return should become 0, so that rate will become the break-even rate of return for the organization. So that's calculation of break-even return is called as the internal rate of return, that can be calculated with the help of the given problems. First, we have to assume two rates, lowest rate as well as the highest rates, 10% as 20%. If both the percentages are giving the positive NPV, then we have to try it for the below that rates. If one is giving the negative NPV and another one is giving the positive NPV, then we can use this formula like R1 plus, that is lowest rate, plus NPV at the lowest rate into the differences between these two rates which are giving one positive and one negative, divided by NPV at the lowest rate minus NPV at the highest rates. If we have done, we can easily calculate this internal rate of the projects. Same here is there also, but here another method we can follow, that is internal rate of return can be calculated with the help of net initial investments divided by annual cash inflows, and if that value at the A4 table, if we have seen, whatever the rate of return that comes, then that will become the internal rate of return. If it comes between the 12%, then 12% will be the IRR. If it is between 12 and 13, we can take the average value of these two rates. That is about the internal rate of return, average rate of return, payback period, post payback periods, and all. And next one, we will go for the accountancy related information. In this one, accountancy, first of all, for the given transactions, we need to prepare the journal entries. So here every transaction has two accounts. One is owner contributed 50,000 and a new computer costing of 20,000 to start a business means. So first of all, the owner has invested 50,000 means the capital, and he has invested the computers means it is a thing. So capital comes under the personal account, computer is the thing, whereas they have contributed towards the business organization only. So this total capital of that particular organization will be 50,000 plus 20,000, 500. So that's way we can say that they have invested cash of 50,000 and the computer of 20,000. Whereas these are all computers comes into the organization as per the real account. Debit what comes into the organization, we have mentioned under this one. Cashes are also coming to the organization. Debit what comes in. Debit the receiver, credit the giver. Here the owner Masuda Abis is the receiver. Debit the receiver and credit the giver. They are giving the capital to the organization. So the owner comes under this credit side. The total capital is 70,500. And the second transaction is office supplies were purchased on account of 4,000 means they have purchased on the basis of the account payables. This account payables are bills, they have to be received. So it is on credit side. Office supplies are all the expenses. As per the nominal account, they are all on the debit side. So like this, we will enter the journal entries. And for each and every account like cash account, computer, and the office supplies, bank loans, utility bills, etc. Separately, we have prepared each and every account. Then it is called as a cash ledger entry. So cash account ledger entry, computer account ledger entry, office supplies, account payables, advertisements, banks, utility, account receivables, drawings. For every account, we can prepare this ledger account. And finally, while preparing this ledger account, if that particular account receivables is on debit side, the opposite account will be on debit side. If this particular account is on credit side, the opposite account comes under the credit side. And finally, if we add all the amounts under the debit and the credit, wherever the balance is less, we will take it as a carried down amount. At the later next month first, we can make it as the balance brought down. And finally, the brought down amounts at the debit side will be written under one side and the carried down amounts will be written under the credit side. Finally, we will see whether the debit amount and the credit amount is balancing or not in the form of trial balance. So that is about the preparation of journal, ledger as well as the trial balances. So here any adjustments will also be taken into the consideration for the preparation of the accounts. And once if that trial balance is done, from that trial balance we can prepare the trading account. The direct expenses means the opening stock, closing stock, purchases, sales, purchases with the less of purchase returns, sales with the less of sales returns, drawings, wages, all the direct expenses and the direct incomes were taken into the consideration. On the debit side, if the amount is less, then we can call it as this gross profit. On the credit side, if the amount is less, we can make it as the gross loss, and that can be posted under the profit and loss account. Whereas in the profit and loss account, salaries, outstanding expenses, rents, transportation, carriage outwards, all the things will be comes, and we will again find out the gross profit, net profit and the net loss, and the net profit and the net loss will be added to this balance sheet. Whereas the balance sheet will be a formula, it is a accounting equation. Owner's equity as well as their liability should be matched with their fixed assets as well as the current assets. So based on that one only, they will be calculates this balance sheet. And finally, the ratio related problems, they will give you all the ratios will be given. Ratios problems will be given like this. The selling price per unit is 40 and marginal cost per unit is 24. Fixed cost is 16,000. Like this, the information will be provided, and they will ask us to calculate this P by V ratios, and sometimes they will ask us to calculate this liquidity ratios.
Like, share and subscribe. Hit the bell icon for more updates.